Hi, I'm James Robinson, and this is my stock thought of the week. So I continue to think that the market is a little bit too expensive and don't really want to be advising you to buy stocks because I'm not sure that you're going to get good results from those stocks. So I'm going to continue my series on thinking through how to invest in stocks, how to research stocks, what to be looking for as a value investor, at least what I think you should be looking for as a value investor. So this is part 7 in that series. So we're going to move on to a section on analyzing operations. In this video, we're going to talk about looking at gross margins. Now, a lot of people would probably be surprised here. The very first thing I look at when analyzing a stock is the gross margins. I don't look at profits. I certainly don't look at share price. The very first thing that I care about is the gross margins because I think that's a very quick way to get a sense if this is a company that I'm likely to be interested in. I do a tremendous amount of investment and invest a tremendous amount of time and research in a stock before I'll buy it. But I don't put a lot of investment and time into every stock that I look at. A lot of them I look at a number of key things and decide, yeah, this company's just not there. So the very first litmus test that I really look at is these gross margins. I'm going to talk about in this video why this is where I start my search. One of the things is that a value investor looks at is companies that, at least a Warren Buffett era value investor looks at is this company a really solid company? Is this company likely to perform for us in the long run? And in order to do that, you have to make some decisions about what it means for a company to perform in the long run and what common traits a good investment will have. And it's sort of like with the way doctors will diagnose a disease. When a doctor is looking to see if you have diabetes, they don't test you to find out what your insulin production is. They look at a very related but very different issue. They look at your blood sugar. If your blood sugar is too high, then they presume that's a very high likelihood that you have diabetes, and they'll do some other tests, an A1C, for example. But basically, they start with a very simple thing. Is the blood sugar too high? And then that leads them down that course. And so I look at gross margins as that same test. It doesn't tell me everything you do about a company, but if the gross margins aren't there, the company almost certainly can't be something I'm interested in. And if the gross margins are there, then it's worth continuing to do my research. So again, what we're looking for is diagnostic measures to figure out if this company is in fact a solid company. So what are gross margins? There are two definitions for gross margins. One is simply revenue minus cost of goods sold. That's sometimes called gross profit also, or margins. But that's one thing. The problem is that doesn't tell me much because that really only gives me a sense of how that company's doing relative to itself, because $50 million or $50 billion of gross margin doesn't tell me anything without context, right? So the second, and that's expressed in a dollar amount. The second way and definition for gross margins, the one more commonly used, is revenue minus cost of goods sold, and then whatever that number is divided by revenue. And that number will be defined as a percentage. And the value of that is if I know what the percentage of gross margins are for company A is, and I know what the percentage of gross margins for company B is, then that will tell me which of those two companies is doing a better job with gross margins. Additionally, I can look at what's happened with the gross margins as a percentage basis over a long period of time and get some sense for what's happening with the company. So we're focusing really only on the second definition as we go through this analysis. So what the diagnostic tool of gross margins, what does it tell us? Well, the first thing that it does is it tells us what the company's pricing power is. So just do a thought experiment with me. If you're a consumer, you want to buy things at the cost of goods sold, right? You're willing to pay the company what it costs to make the product, but you don't want to pay any more than that than you have to. Everybody sort of intellectually understands that a company has to at least break even or it can't stay in business, but you don't want them to make too much money at your expense. So any margin above the cost of goods sold is an indication of pricing power. The higher that margin is, the more pricing power the company has, and the lower the margin is, the lower the pricing power. So we're looking for companies with significant and very strong pricing power. A company that does that is much more likely to be a consumer monopoly. On the other hand, a company with very low pricing power is likely to be a commodity business. So let's think about that in terms of companies we know and understand. So Apple is a consumer monopoly. If you're in the Apple universe, you're almost certainly going to keep buying Apple products. People love the company. They'll pay more for an iPhone than they will for a similar phone made by some other company because of all of the benefits that go with being with an Apple company. So that is almost certainly an example of a consumer monopoly. If you look at companies that are commodity businesses, those are businesses where there's almost no differentiation between two products. So, and airlines are a great example of a commodity business. most people don't really care whether they're flying American Airlines or United or Delta. They simply look for whatever price is the cheapest. And the fact that these things are so interchangeable means that none of those airlines have any real pricing power. And the fact that they don't have pricing power means that they're going to be less profitable, and in general, they're going to be less desirable companies. Now, it's not completely that simple, because there are markets where one company will have a significant stranglehold, and in those markets, they really will have pricing power. American Airlines, for example, in Dallas, has tremendous pricing power, and Delta in Atlanta. But generally speaking, over the entire portfolio of the operations that those companies have, they're commodity businesses. Other examples of commodity businesses are businesses where the price can fluctuate, but they fluctuate for items that are beyond the control of management. So an oil company, for example, when oil prices are high, oil companies do fantastic. When oil prices are low, oil companies do very poorly, oftentimes losing money. And so that's not necessarily an indication of management or anything the company's doing, but it's an indication of what's happening with that commodity. And for investors, what's happening with that commodity is something we can't control. If we can't control it and we can't predict it, we don't really want to be investing in it. So that's just some of the things that we can tell from looking at gross margins. And we can tell it very, very quickly, as you'll see as we go on through this presentation. So continuing on with this concept, Warren Buffett talks that he likes companies with a moat. What that moat means is that it's hard for people to come and compete with you. Warren Buffett used to say that if you gave somebody $100 billion, they couldn't recreate Coca-Cola. It's too big, it's too widely known, the brand, the colors, everything is there. People are used to drinking it. When you walk into a store, you just say, I'll have a Coke. Even if what you really mean is you'll have a soda, people just assume that you mean Coca-Cola. And so the fact that it's very, very hard to break into that industry and to steal market share from you means that you have a moat. When you have that moat, that means you have pricing power. And that means you're a consumer monopoly, which Warren would say makes you a great company to invest in. So we're looking for companies that have a moat. One of the ways we can diagnose if a company has a moat is by looking for pricing power, and pricing power is defined as gross margins. So again, when I see a company with gross margins, I think, well, how else could they get that high margin unless they have this moat? So that's one of the things we're looking for, and that's one of the real quick diagnoses we can do with these stocks. The second thing we want is a durable competitive advantage. There are companies which today are really doing great, but that's not very durable, it's not very competitive, it's not very sustainable. So an example of that was the BlackBerry, right? The BlackBerry had fantastic market share, but in a tech business, in tech industries, oftentimes somebody can come along and build a better mousetrap, and you can almost instantly be out of business. And that's what happened with RIM, the people who made, which is Research in Motion, which are the people who made BlackBerries. So we're looking for a durable competitive advantage. Well, how do we diagnose that? Well, what we do is we look at gross margins over time. And if over time those gross margins are eroding, they're getting smaller and smaller, that means that competitive advantage, that moat, is slowly getting eroded away by the competition. And that company over time is likely to convert from being a consumer monopoly to a monopoly, to a commodity business, and eventually maybe even go out of business. And that's, for example, what's happened with newspapers. They had fantastic moats, they had durable competitive advantages. Then the internet came along, their moat eroded, they became commodity businesses trying to compete on price, and now for the most part they can't even do that, and they're basically out of business. So again, by looking at gross margins and just thinking through what you're seeing there, and we're going to go over some slides in a minute that have some of these presentations, that have some of these characteristics so you can see it for yourself, you can really very, very quickly see, does this company have a moat? Does it have a durable competitive advantage? So a couple more things that I look at, and these are sort of my theories when I'm looking at a company. The first one is altitude theory. So I'm a pilot, and my attitude when I was flying is I always wanted to be as high as possible. So if I was flying somewhere and I could be flying at 12,000 feet or 10,000 feet, I would prefer to do that versus flying at 3,000 square feet. Now it uses a little more fuel, takes a little longer to get to that altitude, but to me the benefits were significant because when I have a lot of altitude and something goes wrong, I have a lot more time to find some place to land or to diagnose and try and fix the problem. If you're at 1,000 square feet, your engine goes out, you have nothing to do but land, and you have to land right now wherever you are. And if you're in a forest, then you're in a forest. If, however, you're at 12,000 feet, you've got plenty of time, 15 or 20 minutes, I guess, depending on what altitude the ground is, but you've got plenty of time to try and get the engine restarted, to get on the phone, on the radio and try and organize getting help, to find a safe and sensible place to set your airplane down. The same thing is true with gross margins. If you've got very fantastic gross margins and something happens and your gross margins get cut in half or gets cut significantly, you can still make money or you can still break even. If you have very, very tiny gross margins, if you got 5% gross margins and a labor strike happens or the price of fuel goes up or any one of 1,000 things that can happen that raise your costs by 3%, you're wiped out. Your company's not profitable anymore. So I look at gross margins as an opportunity for a company to make mistakes and still survive, and as a margin for error to fix things in case things go wrong. So the higher your margins are, it means you can endure bigger disruptions and mistakes. The higher the margins mean you can survive with lower quality. So the management. So let me talk about the next thing. If you got fantastic margins, you don't have to have great management to be profitable. If you've got tiny margins, you need a management that's making every decision right day after day after day after day. And there are companies that are in commodity businesses that get these great managers that are just geniuses, and they figure out a way to make the company profitable and to keep it profitable, and that's fantastic. But those low margins, when that manager retires or quits or gets fired or goes and takes a bigger job, they're disaster because the new people that come in, the next managers, are almost guaranteed to be less quality. And if the company is profitable because of the skill of management and the management isn't going to live forever or isn't guaranteed to work for you forever, then you're going to go from a great company, which is great because of the way it's being managed, to a mediocre or losing company, which is happening because it has even just average management. So a company with high margins can do great with average management. A company with low margins, it's almost a disaster to have average management. And we have to assume as an investor over the long run, every company is going to have relatively average management. So before I go on, if you're liking these videos, I'd like to suggest that you follow me on Twitter. My handle is @RobinsonStocks. I'd also like you to subscribe, to like, and to comment to the videos like everybody would. If you do follow me on Twitter, you'll get real-time information on trades. I am buying and selling some stocks now, not a lot, but I am doing it. When I buy or sell something, I don't always make a video. If I have a company I've already made a video on, for example, and I'm buying or selling more of it, I will simply put on Twitter, hey, I bought more today, and I'll put the price that I bought it so that people can track my results and what I'm doing, but I won't always make a video. I also put updates when I make new videos, and finally I put news and thoughts from the market and stocks and other videos that I find that I think are interesting. So feel free to follow me on Twitter @RobinsonStocks. So now on with the video. So here we can see the gross margins for Tyson. Tyson is famous for making chicken. They're very much a commodity business. And look at these margins that they have. They are very, very, very low, in the range of 10%. So if something happens that's a disruption in the chicken market, feed goes up, taxes go up, cost of transportation goes up, there's a union shortage, there's a storm or hurricane or tornado, or any one of 1,000 things that happen, it can cause enough of a disruption that you have more than a 5% moderation in profit, and that means that Tyson goes from being a profitable company to an unprofitable company. It'll do fine in situations where the management's doing great because they'll figure out a way through that. But again, average management and you get in real trouble. Let me talk about this chart so you'll understand it. The purple line is the top 10%. That's the top 10% of all companies that I look at. It's not related, that purple line is not related to Tyson, it's related to all companies in the marketplace. And then the next line, blue, is the top 25%. Then green is what I consider to be a desirable margin. So 40% is any company over a 40% margin is a company that I'm interested in buying. Gross minimum, the red line, that's the minimum gross margins. I'd have to have a really, really good reason to buy a stock with the gross margins lower than 20%. And then the bottom 10% of companies is in orange. So those straight flat lines, that's of all the 1,000 companies that I look at where the numbers fall for margins. And then the blue line is what's happening with Tyson. So again, I don't want to own Tyson if they get a change in management, which is not predictable. I don't want to own Tyson if something goes wrong, which is not predictable. And so I can't come up with a good reason why I would ever own Tyson. So here you can see the exact same chart, but in this chart we're looking at Visa. Now Visa has very, very little cost of goods sold, which means they have very, very high margins. So they have very high pricing power relative to their costs. And you can see that they're in the top 10% of companies, and in fact their gross margins have been expanding. So that means that their competitive advantage is being enhanced year after year after year. There's no sign of it eroding, and they're in the top 10% of companies. So they're doing wonderfully in this category. This is very much a company I would love to buy. The problem is everyone in the world knows it's a great company, and they bid the price up to the point where it's currently too high for me to buy it. But I would buy this company in a split second if there was ever a situation where the price dropped enough for it to be exciting. But again, look at these. The next slide is looking at Tyson and Visa next to each other. I can't come up with a single reason why you would ever buy Tyson when you could buy Visa, almost regardless of the price Tyson was being sold at. I mean, if Tyson was being given away, I suppose I would take some, but I can't imagine shelling out any hard-earned money for it. So here's an example of a company whose gross margins, they show a non-durable competitive advantage. So once upon a time, CBRE was a fantastic company looking at it from gross margins. It was above my 40% threshold, and it was doing fine. And then starting really in about 2006, it's gone down virtually every year. And now it's, down from, call it 55% to call it, 30%. And it's no longer a company that I'd be interested in. Now, for my day job, I work in commercial real estate, and I know CB very well. I know their business, I know their tactics. CB has for a number of years been simply trying to buy market share. They have been trying to buy deals. In the tenant rep business that I'm in, oftentimes they will give the tenants part of their commission as an incentive to get hired. And so what that's doing, that and a number of other strategies, are making it so their cost of goods sold relative to their revenues is going up. And that can happen in two ways. If your cost of goods stays constant and you make less money, that can happen, which is probably what's happening with CBRE. But also if your cost of goods sold are going up and your costs are level, that can have an effect. With CB, it's probably both. But again, I just want you to see here that CB's competitive advantage has been eroded. Part of that's because of companies like Jones Lang LaSalle and Cushman & Wakefield and others in my industry. Part of it is because technology is making it so that their knowledge base, the information they used to be able to provide to their clients, is more readily available, so people aren't willing to pay as much. And part of it is that they are out there trying to hustle up business by competing on price. You add all that up and you have a reduction in durable competitive advantage, and you have a company which looks less and less interesting to an investor. Here's the same chart for Apple, and this is really the opposite, and it's kind of not intuitive of what you would have predicted. But since about 2006, Apple's gross margins have increased, and then in about 2013 they've been pretty constant. But there's no sign of their market share eroding, and that's very interesting because tech companies, for example, Research in Motion, we talked about, the company that made the BlackBerry. Oftentimes what happens is other people come in and copy whatever genius you created and compete with you, and your margins will erode over time, especially for tech companies. But with Apple, that's not the case. They continue to innovate. They continue to come with new products which are cutting edge, or which are, even if they're not as competitive, as cutting edge as they could be, they're desirable. They're desirable because the consumer really wants them. So they have this consumer monopoly that we talk about. I'm an Apple guy. This video that I'm making is shot on iPhone. It's edited on a Mac computer. I do work on my iPad. I'm Apple through and through, and I can't imagine I'm going to change. And that's why they can sustain these margins, because they know I'm going to stay here as a customer as long as they keep producing fantastic products. So it's really interesting when you look at this, the two slides together. You can see CBRE, their margins are eroding. That's less desirable. Apple, their margins have increased and are now flat for a very long period of time. That shows me that's a company that's able to sustain its moat and has a durable competitive advantage. So in summary, in going through this video, we've talked about what the definition of a gross margin is, why I think it's the place that I start my search. We've talked about how it can be used to diagnose whether a company is a consumer monopoly or whether it's a commodity. We've talked about how it can be used to determine if the company is a moat or a durable competitive advantage. We've talked about the altitude theory and the fact that average management over time is who you have to assume is going to be running your business, and that if you're going to have average management, you'd prefer to have high gross margins versus low gross margins, because with low gross margins, really the only way to be successful is to have excellent management, and you can't predict that. We've also talked about the effects of stable versus declining margins, and how we use that as a diagnosis for durable competitive advantage. So I just want to go over again. This is one slide that has a lot of information which can be used to diagnose an awful lot about what's going on about a company. And if I see the gross margins aren't where I want them to be, I become pretty disinterested. I continue to look at the stock, but there has to be a whole bunch of really good reasons for me to invest in that stock that are beyond the scope of simply gross margins. One example of that is the company Paychex. If you remember, Paychex has tiny gross margins, but that's artificial because with Paychex, they collect the money to pay the employee, the temporary employee. They pay the money out to the temporary employees and they keep a tiny sliver. So they show these gigantic incomes, but 95% of it goes out. So that is not really the same thing as a true cost of goods sold like you'd see for Caterpillar or Apple. But generally speaking, and that's why if I spend a lot of time on Paychex, you'd understand and you'd see through that. But generally speaking, no gross margins or low gross margins, and I'm not interested. So that's it for gross margins. Thank you very much for your time, and I'll see you in the next video.